What is petty cash? A petty cash fund, as defined by the ACCT financial textbook, is an amount of cash kept on hand to pay for minor expenditures. Businesses use petty cash to purchase small supplies such as office supplies, cleaning supplies, or postage. There are 3 steps involved with petty cash, and they include establishing the fund, making payments from the fund, and replenishing the fund. Step 1. Establishing the fund. The business will have a designated person responsible for the petty cash fund and writes a check for the amount they are putting into the fund and gives it to them. To demonstrate this, let's look at a cafe called Organic Retreat. On the 1st of July, Julia writes a check of $100 to establish the petty cash fund and designates it to her employee Jackson, the custodian. The following journal entry would be recorded by Julia. As shown, petty cash is debited and cash is credited. Step 2. Making payments from the fund. After the fund is established, the petty cash fund is used for minor expenses. Payments can be made in 2 ways. Cash can be taken straight from the fund to make payment, or employees seek reimbursements from funds personally made. Both cases require Jackson to collect receipts and authorizations for the use of the cash. Note that journal entries for these payments are only recorded when the fund is replenished and therefore are not needed until replenishment. Step 3. Replenishing the fund. The final step arises from the need to replenish the fund as cash in the fund decreases, and in this step, a journal entry is required. The remaining cash in the fund is counted, and the business cashes a check for the amount that returns the total cash back to the original balance. The business also records all expenses from the documentation of saved receipts. To illustrate this, suppose on the 31st of July, Julia examines the petty cash fund and prepares this report. It is evident here that Julia has $25 remaining in the fund as Jackson's receipts total to $75. This demonstrates that Julia needs $75 to replenish the funds. Julia then prepares the following journal entry. What happens if receipts do not equal total amount of cash needed for replenishment? In some cases, a business may discover a difference in the total amount of receipts and amount of cash needed for replenishment. The difference is charged to a temporary account called cash short and over, which can either have a debit or credit balance. Cash is debited if it is short and credited if it is over. This situation may occur if the custodian has not kept all receipts or gave incorrect change, resulting in the difference between the cash needed for replenishment and the number of receipts. For example, Julia attempts to replenish the petty cash account, but instead of $25 left over in the fund, there is a shortage of $3 as there is only $22 remaining. Therefore, the cash over and short account must be debited $3 to correct the balance. Thanks for watching.